watching the price of oil this morning. It is higher. Brent is briefly moving above $70 a barrel early this morning for the first time in over a year. As you can see, Brent right now is at $69.55. That is up 0.25%. Crude oil, meanwhile, West Texas crude hitting the highest level since October 2018 at $66.28. The surge coming after Saudi Arabia said its oil facilities were targeted by missiles and drones yesterday. Yemen's Houthi forces claimed responsibility for that attack. And it's time for the word on Wall Street. Top investors watching your money. Joining me right now is Crescent Wealth Advisors founding partner and chief investment officer Jack Ablin, Bulltick Capital Markets chief strategist Kathryn Rooney Vera, and Michael Lee strategy founder Michael Lee. Great to see everybody this morning. Happy Monday to you. Kathryn, kicking it off with you. Markets are under pressure ahead of the trading week. The 10-year yield, one of the issues here, hitting 1.6% for the first time since last February. As you can see, it's at 1.599%, up 3 basis points after the $1.9 trillion COVID bill passed the Senate. We heard from Federal Reserve Chairman Jay Powell last week. What does this mean for the Fed's outlook and for inflation? Why do you think markets are reacting so negatively to the move in yields?
Yields have been so low and in such a straight downward trajectory for so long, Maria, that this is a shock to the markets. The markets are finally pricing in some semblance of inflation over, let's call it the near to medium term in the 12-month horizon. I think that's right. We have a combination, a very potent combination of inordinately extravagant fiscal policy as well as exceedingly accommodative monetary policy to the tune of 30% of GDP for monetary policy, which is what the Fed owns on its balance sheet, and 20% fiscal deficit if you look at a fiscal year 2020 time frame. So the amount of stimuli has been unprecedented, and that's what I think the market is looking at. Of course, as Treasury yields move higher, that takes away the earnings yields from that equities have enjoyed for years. So as those yields move higher, it takes away that attractiveness for equities. And I'll also add, Maria, that this is repricing the possibility of Fed hikes for the next several years. If, in fact, we do get inflation, then the market is pricing in Fed hikes. I will say, though, if we get yields moving towards the 2% in this velocity, in this state of rapidity, Maria, I do think the Fed is going to clamp down either with yield curve control or some form of Operation Twist or firm caps on 10-year Treasury yields, because this goes completely against, Maria, everything that the Fed has been trying to do for the past 10 years. Every 100 basis points move higher in 10-year Treasury yields is the equivalent to a 77 basis point, 0.77% increase in the 30-year fixed rate mortgage. So the costs of financing increase inordinately with the speed and the velocity and the magnitude of 10-year Treasury yields ascent.
Well, this is likely to be the biggest bill in U.S. history until we get the next bill, which is going to include higher taxes. I'm looking at a Cowen report this morning, and the analyst there says that we are expecting a $3 trillion recovery bill to move via reconciliation party line in the late third quarter, possible for enactment given the speed of the relief bill. Jack, what about that? A lot of people concerned over heightened inflation due to the stimulus bill and what's coming next. This is $1.9 trillion. Cowen's talking about a $3 trillion package, including higher rates announced at the end of March. These concerns have pushed the NASDAQ lower now for 3 weeks, as well as that spike in bond yields, putting pressure on big tech. Your outlook for inflation, and would you buy oil stocks, for example, or how do you play this, knowing that oil is up to 66 and yields are moving up as well?
Yeah, in fact, oil infrastructure, that whole complex is probably the cheapest area of the market around. Just about every other equity major sector is bearing the needle in terms of valuation, enjoying these lower rates over the last 10 years. And yet energy infrastructure in particular still trading at or below the 25th percentile of its historical range. Of course, that sector had a terrible year last year in a pandemic, but it seems to be rolling back this year, and it looks like it will continue to gain on the back of higher inflation in the back half of this year.
So would you buy into this then? Do you think that yields moving up is a trigger for you to get even deeper into fixed income then, Jack?
No, I think that I'm not ready to reposition in fixed income yet. Our fixed income positions are lower maturity, so we have less sensitivity to rising rates. We do like energy. We've bought energy infrastructure toward the end of last year. And so we think that real rates, if the Fed stays put, will actually go further negative to a point where we could see, let's say, a 4% print in inflation readings in the fourth quarter of this year, combined with a 0% overnight rate. That's a 4% negative real rate. That's great for commodities in general. That's great for oil stocks. And it's really good for gold. That would suggest a roughly 40% return in gold if those conditions exist at the end of the year.
Wow. That is a nice move. Michael, we've already seen a huge move in oil stocks. What is your take on the price of oil following that attack on a key Saudi Arabian oil facility over the weekend? But even before this event, Michael, you've got these oil stocks showing some very nice performances when you look year over year.
Yeah, Maria, we are in a bit of a perfect storm for oil. You've got a new administration that's extraordinarily hostile to the entire industry. You combine that with a recovery that's happening much more fast and furious than not only expected, but kind of well beyond the wildest dreams, creating a demand situation. And then when you add on top of that, OPEC not increasing output and the tensions in the Middle East, you form that perfect storm to where oil has moved higher dramatically. The XLE sector has gone from the 30s. Now we're up into the mid 50s. I think that will continue to run. I don't know that we'll get another 50% in it, but it's something to look at. I don't know that this move in oil is necessarily a knock-on effect and a continuation into higher inflation, but I think higher oil prices, a return to normalcy where we're seeing oil in the $50 to $60 a barrel range is likely to continue, especially because in the U.S. the lack of new fracking and the bans on federal lands and that sort of thing will keep a floor under oil prices for the time being. That, and then the economy's taking off. We're recovering much quicker than anybody expected in their wildest dreams, with more stimulus coming along. So it's going to be interesting to see that play out. But I think, as Jack mentioned, the oil services is where you want to be looking now. That has not moved the way that the rest of the oil stocks have moved. And so I think that may be the next rotation.
All right, we'll be watching. Jack Ablin, Kathryn Rooney Vera, and Michael Lee. Great to see you all. Thank you so much. We've got much more ahead this morning.